The market screen, usually a calming mosaic of greens and blues, bled a violent singular red. A cold dread, familiar as a bad dream, seized my chest as the number plummeted, erasing a week's meticulous gains in a single gut-wrenching minute. This wasn't some random market volatility. This was me. Every instinct, every meticulously charted strategy, every hour spent analyzing trends had been discarded for a panicked, last-second decision. I'd seen the warning signs, drawn the lines on my charts, plotted stop-losses with obsessive precision. Yet when the actual moment arrived, an irrational impulse, a whisper of fear, a phantom tremor of past failures overruled everything. It was a familiar glitch, a self-sabotaging reflex that consistently derailed my financial progress. I understood market mechanics inside out, but controlling the sudden tremor in my own hand remained impossible. Each time after the dust settled, the same unsettling question lingered. Why, despite all my intelligence and preparation, did I repeatedly choose to undermine my own success? The sudden stillness after the market's latest upheaval was deafening. For weeks, I'd blamed every external variable: rates, competitors, fleeting investor confidence. Yet the stark silence insisted on a different inventory. It wasn't the chaotic market betraying me, but a familiar pattern, a subtle hesitation, a premature retreat, a subtle withdrawal. From this internal reckoning, the true antagonist emerged. Not incompetence, but a deep-seated fear of losing control, ironically manifesting as an urgent need to dismantle my own progress preemptively. This was subconscious self-sabotage, an invisible hand on the brake. Understanding this quiet adversary within became the terrifying first step toward reclaiming my narrative, away from external noise. The initial optimism, that bright, almost blinding belief in my own potential, felt like a distant echo now. Back then, armed with textbooks and online courses, I saw myself as a disciplined strategist, capable of dissecting market complexities and extracting profit with surgical precision. My early trading journal, a small, unassuming notebook, was initially filled with neat charts and confident predictions, but the reality that unfolded within its pages quickly became a chaotic testament to a different story. Despite acing every simulated scenario and reciting risk management rules like scripture, my live accounts told a different tale. The moment real money was on the line, theory evaporated. A small loss would trigger a visceral need to get it back. Classic revenge trading. I'd double down, then triple, watching small dips morph into chasms. I recall one particular incident in late 2017, a rapid dive on a tech stock. My initial entry was sound, but instead of cutting losses at $500, I averaged down. By the time I finally capitulated, the single trade had cost me nearly $4,000, leaving a cold pit in my stomach and a furious scrawled journal entry: blind anger, no plan, just noise. This wasn't an isolated event. Over the next 3 years, these learning experiences compounded. My meticulously tracked profits were consistently wiped out, often in a single impulsive session of averaging down on losing positions without a defined exit strategy. The total tally across brokerage accounts, a grim ledger of tuition paid, quietly bled away, over $30,000. Each loss fueled a deeper frustration, reflected in the increasingly frantic margin notes of my journal, where rational analysis was replaced by expletives and self-recrimination. The words were a snapshot of the internal chaos. Why do I do this? The pages of that journal, stained with coffee rings and underlined with desperate urgency, chronicled a painful education. They were evidence of a pattern that needed to be broken, a spiral that had to stop. The true pivot didn't happen in a single dramatic moment, but in the quiet, dawning realization that I was diligently sabotaging myself. I had spent years reacting, patching wounds, and hoping for a different outcome while repeating the same chaotic patterns. That morning, however, I made a definitive decision. The era of accidental living was over. My past had been a tangled web of knee-jerk responses, but my future would be built on intentional, disciplined protocols. To understand why I kept falling into familiar traps, I dove into the psychology of decision-making, researching biases like loss aversion, which made me cling to the known even when it was detrimental, and confirmation bias, which allowed me to rationalize inaction. This wasn't about vengeance yet, it was about internal architecture. Have you ever felt this, trapped in a cycle where your own mind felt like the biggest hurdle? Let me know in the comments. These insights weren't just academic, they became the bedrock upon which which my 3 critical protocols would soon be constructed. The blueprint wasn't a static document, it was a living commitment. Every morning, the first protocol activated, a mandatory 15-minute market scan, not for opportunities, but for confirming my risk parameters, a screenshot of which was immediately logged. My chosen analytics platform, ChartPath Pro, became central, its digital canvas displaying revised trading plans, each entry overlaid with precise risk-reward metrics. This deliberate, almost clinical process stood in stark opposition to the frenetic, impulsive choices that had previously dominated my trading days. My physical trading journal, once a graveyard for gut feelings, slowly filled with disciplined, almost robotic entries, each detailing rationale, execution, and adherence to my boundaries. The friction was palpable. During volatile market surges or sudden drops, every fiber urged me to deviate, but the rules held firm. Each documented decision, a quiet victory, was slowly cementing a new, unshakable foundation. The disciplined execution began to yield its first faint tremors of success, enough to challenge the deep-seated skepticism I hadn't realized still lingered. I'd implemented the conservative strategies, adjusting my portfolio as methodically as I'd once organized my research files. Initially, the gains were modest, almost imperceptible against the backdrop of past losses, but they were consistent. A small win here, a steady upward tick there, concrete artifacts accumulating on my monthly statements. The true shift, however, wasn't purely monetary. It was internal, where once the trading screen had been a blinking taunt, a conduit for anxiety and impulsive reactions, it began to feel like a chessboard where I was finally dictating the moves. Then came the week of unexpected market volatility, a sudden dip that in the past would have sent me into a spiral of panic. But this time, something fundamental had changed. I felt a surprising, almost alien calm, my adherence to the plan unwavering. The red numbers flashed, yet I held firm, executing my predefined stop-losses without a tremor. The screen, once a battlefield of emotion, now quietly displayed the controlled, profitable movements of a strategy coming to life, proving that even a small, steady hand could weather the storm. The quiet confidence I'd meticulously built began to hum, a low, steady vibration of competence that settled deep within me. My new system, a fortress of logic and discipline, had performed admirably in its nascent stages, yielding the predictable small gains I'd engineered. But the market, a fickle beast that respects no individual triumph, had other plans. It wasn't long before the inevitable storm clouds gathered on my meticulously charted horizon. A week turned into 2, and the indices began a slow, insidious decline. My carefully diversified portfolio, which had seemed so robust, wasn't immune. A core position, one I'd researched for months, suddenly posted an earnings miss, sending its value spiraling. Then another, a long-term hold, announced a regulatory hurdle. My screens, usually calm, became a battlefield of red numbers and downward arrows. This wasn't a catastrophic crash, not yet, but a persistent, eroding drawdown, a test of pure endurance. By the end of the 3rd week, my total portfolio value had dipped 7%, a figure small enough not to panic the seasoned, but large enough to rattle the foundations of my hard-won resolve. The old whispers, insidious and familiar, began their resurgence. "See, this is just like before," they hissed, echoing the self-sabotaging doubts that had plagued me for years. "You thought you were different, but you're still just a lucky amateur. This won't last. You'll lose everything again." That gnawing fear, the one that had made me bail out of positions too early or chase fleeting trends, pressed against the new bulwark of my discipline. I felt the primal urge to intervene, to fix it, to abandon my carefully constructed rules and revert to the frantic, reactive trading that had cost me so much. My finger hovered over the sell all button more than once, a phantom itch of panic beneath my skin. It was a battle waged not against the external market, but against the antagonist within. Each morning, reviewing the red portfolio, I chose adherence over anxiety. The discipline wasn't a static achievement. It was a daily act of vigilance. I referred back to my journal entries, my risk parameters, the cold, hard logic that dictated patience and rebalancing, not capitulation. The numbers on the screen were just information, I reminded myself, not a verdict on my worth. This period, painful in its relentless chipping away, taught me that progress was not a linear ascent, but a series of managed descents and ascents, a constant ebb and flow that tested the true strength of my my foundations. It was a sobering reminder that while external chaos might be unpredictable, my internal response was entirely within my control. The drawdown eventually stabilized, but the experience underscored a profound truth. The fight for mastery was a perpetual one. My system was robust, but my mind required constant tending, a quiet, unwavering commitment to the path chosen, irrespective of the market's unpredictable tides. The quiet in my mind, once a distant dream, became the new norm. I had conquered the internal battle, not with a sudden victory, but through sustained discipline, a daily commitment that transformed frantic screen gazing into precise, strategic action. This wasn't about chasing explosive profits that evaporated as quickly as they appeared. Instead, I cultivated a sustainable rhythm, establishing strict trading hours and strict risk parameters that honored my personal life as much as my financial goals. The old me, driven by anxiety and an insatiable hunger for immediate gains, had often neglected everything else. The new me understood that true wealth wasn't built on adrenaline, but on the quiet accumulation of consistent small wins, month after steady month. It was like watching a powerful river carve its path, slow, relentless, and ultimately unstoppable. If you're ready to break free from self-sabotage, consider what protocol you need to start with this week. The screen still glowed with numbers, but the frantic energy that once pulsed through me had finally dissipated. I recalled those early days, a frustrated gambler chasing quick wins, letting every market flicker dictate my mood. Now the quiet hum of my computer was no longer a source of panic, but a steady companion for deliberate action. I wasn't battling the market anymore. I was dancing with it, acknowledging its rhythm, patiently waiting for my moment. My future as a market participant is not about grand pronouncements, but about consistent, incremental growth. It's about perpetually refining my strategies, stress testing my risk parameters, and continuing to learn from every trade, big or small. The discipline I'd cultivated wasn't just for profit, it was for peace. My greatest trade wasn't a stock, a bond, or an option. It was myself, finally profitable and free from the chains of self-sabotage. This new identity, built on resilience and rigorous self-analysis, meant every morning brought not dread, but a calm, strategic readiness for whatever the market chose to reveal.